Today's guest is MacLane Wilkison, the contributor to the Threshold Network and founder of NuCypher. Threshold Network is offering a decentralized approach to wrapping Bitcoin. Currently, there is one primary option for wrapping Bitcoin, meaning taking Bitcoin and then allowing it to be handled on Ethereum in smart contracts. We discussed why that's important and what the risks of the current centralized model are, and where Threshold is in its launch and future projections. We touched on the current banking crisis and how the mad rush into Bitcoin will increase the demand to have functionality for Bitcoin, as well as the negative external consequences of the current banking crisis and much more. I hope you enjoy this conversation as much as I did. If you do, please share the conversation, share Around the Coin podcast, like it, subscribe. Very much helps us grow and helps us bring on better guests. Without further ado, here is MacLane Wilkison. All right, MacLane, I'm excited to chat with you more. You are running an exciting project, Threshold Network, and you've been a part of some other exciting projects in the past. Maybe just to set the table, can you give me a quick background as to what you're currently working on, why you believe it's exciting, and we'll go from there.
Sure. So I am a contributor to Threshold Network, which is kind of a layer on top of Ethereum that exposes essentially threshold cryptography as a primitive to developers. The main application that we're developing right now, that we actually just launched the initial version of at the end of January, is something called tBTC. This is actually the second iteration of tBTC. The first iteration ran on something called Keep Network, but tBTC is essentially, if you're familiar with wrapped Bitcoin or wBTC, tBTC is essentially that same idea where you have Bitcoin on the Bitcoin blockchain, but you want to use it in the DeFi ecosystem to lend, to borrow, to do all the things that we like to do with DeFi. But instead of a centralized custodian that holds on to that Bitcoin for you, like in the case of wBTC and BitGo, tBTC replaces that centralized custodian with a decentralized network, which is all the stakers that are running nodes on Threshold. And so it's a decentralized, permissionless, and censorship-resistant version of a wBTC, effectively.
So why would someone use wrapped Bitcoin? And maybe if you could explain a little bit more on who is holding it, who's holding the actual Bitcoin, wrapped Bitcoin.
Sure. So the reason why you would use something like wrapped Bitcoin or wBTC is, let's say you have a bunch of Bitcoin on Bitcoin blockchain. You're long Bitcoin, you like Bitcoin, you hold Bitcoin, but you also want to put that Bitcoin to work. You want to lend it out, you want to borrow against it, you want to potentially LP it and look at decentralized exchange to earn fees or some sort of yield on top of that Bitcoin. There's no DeFi ecosystem effectively in Bitcoin because there's not smart contracts system, but there is a very thriving decentralized finance ecosystem, primarily in Ethereum and other layer twos on top of Ethereum and some other alternative off-chains. What wBTC or any sort of wrapped Bitcoin allows you to do is it bridges the Bitcoin blockchain to Ethereum to other chains. So you can effectively move your Bitcoin to those ecosystems and then participate and earn yield, lend, borrow, et cetera. How wrapped Bitcoin works, which is currently the largest Bitcoin bridge, it's centralized. So what you do is you actually send your Bitcoin to a company called BitGo, who is a custodian. They hold on to that Bitcoin for you. And then on the target chain, the chain where you want to, quote unquote, move that Bitcoin to, they will issue you a tokenized representation of that Bitcoin. And that's just an ERC20 token of wBTC. And then you can use that wBTC as you can any other type of Ethereum token. You can LP it on Curve, you can borrow against it, you can lend against it, or you can lend it out. And so the key piece is that you can always redeem it back. So if you have wBTC, actually as a individual retail user, most of us can't. They have this concept of merchants who do this. But you can theoretically redeem a wrapped Bitcoin back to the native Bitcoin on the Bitcoin blockchain. So it's essentially just sort of connecting these two very distinct ecosystems and bringing all of this value and collateral that lives on the Bitcoin blockchain over to the DeFi ecosystem.
And how do you personally think of the risk involved in that whole process? Where would you actually draw some significant risk?
Sure. I mean, so first off, like I think BitGo is a great company. So these are all just like in principle risks, but I think we saw a great example of the issues and challenges and problems when something goes wrong with centralized bridges over the last year, particularly around sort of the Alameda and FTX collapse. There were multiple centralized bridges who operated in a very similar way as wrapped Bitcoin, where you send your crypto to a custodian. A very good example of this is wBTC, where you would send your Bitcoin to a wallet controlled by a small multisig, which turned out to be effectively controlled by Alameda, unfortunately. And they issue this tokenized representation, wBTC, on the Ethereum block. Obviously, what happened when Alameda and FTX collapsed is all of those, essentially, they ran out of funding. They no longer funded the bridge, so they had to turn off additional mints. And it's kind of unclear what's happening to the currently deposited Bitcoin there. It seems like it's getting sucked into sort of bankruptcy proceedings. And so there's an argument that it's not the actual wBTC holders that have a claim on the underlying Bitcoin. It's actually creditors of Alameda and essentially. So that's a very obvious risk, is like the legal status of this custody Bitcoin is unclear. I think it's very likely that, I don't know the details, but I assume that BitGo has much tighter sort of segregation of funds and things like that than wBTC does. So hopefully, like in the case of a BitGo bankruptcy or acquisition or something to that effect, the actual ownership claims of that underlying Bitcoin would be clear, but I don't, that is certainly a risk that people are taking when they use wrapped Bitcoin or any centralized bridge. The other concern, obviously, is just outright maliciousness. So if you're trusting a custodian, I think it's probably valid to trust BitGo, whether a US corporation, but theoretically, like if a rogue employee or the company itself just decides that they no longer want to, the value prop for them just taking that Bitcoin is higher than the value prop of continuing to run this bridge. You're essentially trusting them not to run away with it. And then the other piece, which even if you assume that these centralized bridges are in good financial shape, then they have generally a lot of regulatory exposure. If you want to use wrapped Bitcoin, like it's pretty unlikely that you or I are going to be able to go to BitGo and send them Bitcoin and have them mint off wBTC. Generally, the way that it works is they have a system of merchants who they exclusively work with to do that. And so you and I would have to go to a merchant and do KYC with that merchant and AML compliance with that merchant and be onboarded as a customer. It is pretty unlikely that like BitGo is going to be interested in having a direct customer relationship with like you and me or another retail investor. They generally only work with larger institutions. So it's not even generally like available in some cases for like the longer tail of crypto holders to work with these bridges. Instead, you have to buy like wBTC on a secondary market like Curve or a centralized exchange if you wanted to actually access it.
Interesting. And given that say BitGo is in the US, the US government could in theory just come and shut them down and say, hey, don't send any of the Bitcoin back. And they would.
Yeah, I assume that BitGo is going to comply with any order or regulatory request. The United States government and most European governments, and beyond that, who knows? And so, like that's another thing is like if you're out of like if you're not a resident of the West, like if you're not in the US or Europe, it's even more unlikely that you're going to be able to do business with some of these centralized bridges like wBTC. And so I think that's where the interesting aspect of permissionless comes in is if you're in China and you don't have an English language ID and you can't onboard with some of these vendors, you can do all of that permissionlessly with something like wBTC.
So how would that work? Yeah, maybe by comparison. So we walked out the example of wrapped Bitcoin with BitGo, the risks there. What would be the analogy now on the permissionless side of what you're on?
So tBTC is, I guess at root, like the same idea of moving Bitcoin to Ethereum and to other DeFi ecosystem.
Sorry. What is tBTC?
Yeah, essentially threshold BTC. So that's what we call essentially the tokenized representation of deposited Bitcoin on Ethereum. It's an ERC20 token. So tBTC versus a wBTC.
And so would that be a competing way to wrap Bitcoin, effectively offer the same value prop on top of it? Yeah.
Essentially an alternative bridge to wrap Bitcoin that is one, decentralized. So there's no central custodian in the middle that's holding on to all the Bitcoin. So instead of the threshold network has several hundred stakers who have to bond the native key token for threshold in order to run a node. And then the Bitcoin is basically the way tBTC works is 100 of those stakers are selected to essentially compose one wallet on the Bitcoin side, and depositors send Bitcoin to that wallet. It's custodied across the Threshold network, and they're minted on the Ethereum side a tBTC token. So even if some of those stakers went out of business or decided just went offline or weren't available, you're not reliant on any single one of them for the system to operate and for that Bitcoin to be custodied correctly. And the other piece is it's permissionless. So you don't need to onboard with a centralized entity as a customer. You just go and you interact with smart contracts. So if you have a self-custodied wallet on the Bitcoin side and on the Ethereum side, you can do all of this without the permission of anyone. And then the third piece is that it's censorship resistant. So because there's no central entity that's custodying the Bitcoin and minting tBTC, there's essentially no way for someone to be blocked because they live in the wrong country or China or some place where a regulator might not want them to have access to something like BitGo.
And that's because the miners are living in different countries.
That's because from the user perspective, you're just interacting with a smart contract. So it's an immutable smart contract, and you don't have to create an account. You don't have to register. As long as you have a Bitcoin address and an Ethereum address, you can use the system.
Got it. Okay. So you said miners bond a native T token. What does that mean?
Yeah. So T is the native token for Threshold Network. It's an ERC20 token. And if you want to run one of these tBTC nodes, and the tBTC nodes, again, like they collectively custody the Bitcoin, and they also are responsible for minting the tBTC token on the Ethereum side. If you want to run one of these nodes, you have to stake a certain amount of T tokens. It's essentially like a Sybil resistance mechanism because it basically requires these node operators, these actors to get in the game so that they're economically aligned and behaving correctly. You stake T, and then you have to run a node. And the node, what they're doing is that they're essentially acting as signers. So each time a deposit wallet is created, 100 of those nodes are selected randomly based on stake weight from the network, from the entire pool of stakers. And they participate in something called a distributed key generation ceremony, so DKG. And that DKG is basically how you create the Bitcoin wallet address that depositors are sending the Bitcoin to.
Oh, okay.
Yep. So they participate in the ceremony. There's 100 of these nodes that collectively control any single Bitcoin. And if a quorum of them agree, they use something called threshold signatures. So another acronym, TSS, to basically spend that Bitcoin. So the only time they would spend the Bitcoin according to the rules of the protocol is if someone wants to redeem back from tBTC back to native Bitcoin. So they would go on the Ethereum side, they would take their tBTC, they would go to the smart contract, they would say, I want to redeem this tBTC for native Bitcoin, here's my Bitcoin address. And then those nodes would collectively sign a Bitcoin transaction to transfer the native Bitcoin back from the custody wallet to whatever the user's Bitcoin address is that they want to redeem back to.
Awesome. That was a great way to explain it. So when you were explaining the BitGo scenario, immediately in my head, I'm thinking, how would you possibly design the system to not have this be just in one company, centralized, vulnerable to the company's malicious intent, mistakes, or the government's intervention? And so tell me if this is the right way to sort of simply describe it, is that you have to do a couple key steps in order to wrap Bitcoin. And the reason you want to wrap Bitcoin is you want to be able to use the smart contract functionality that Bitcoin itself doesn't have. And so you have to get it into Ethereum land, at ERC20 land, right?
Yep.
And so in order to do that, you create a wrap token, which you need to have a depositing address to put Bitcoin in. You have to hold that. And so there's some security concerns to make sure that's a safe method for holding the Bitcoin. And then you have to issue the wrapped Bitcoin, and then you have to be able to go backwards. And so the ceremony is, I love the word, just ceremony, to create a Bitcoin wallet. It's amazing. And so the ceremony is a group of 100, no less than 100. And then each of them, you need 100, and then they all together work somehow to create a Bitcoin address. Is that?
Yep.
Is that right?
Yeah. So basically you have a distributed key generation that happen every week. So each week a new wallet is created. So these nodes participate, they generate a wallet. And then that wallet is essentially, it's not controlled by any one of them. It's controlled by all of those nodes collectively. And then if a majority of them agree, they can sign a transaction.
Okay. So the,
51 of 100. This is actually tunable. So it's 51 of 100 now. We could potentially, via DAO governance, change it to 2/3, for example, in the future, if the system scales and starts to hold quite a significant amount of Bitcoin. But basically, assume it's just 51 for now, for an honest majority. If 51 of those of 100 of those nodes agree that like a redemption going back from tBTC to Bitcoin is valid, they would check the Ethereum blockchain, verify that the redeemer has basically sent the tBTC back to the contract. They would say, yes, this is good. If 51 of 100 of them sign the transaction, that becomes essentially a valid Bitcoin transaction that can be broadcast to the Bitcoin network and mined. And yeah, so that currently happens weekly. A new wallet is created on a weekly basis. And right now, the current state of this, we launched minting from Bitcoin to tBTC at the end of January. And we're just basically testing that with a relatively small amount of TVL at the moment. And then like redemption will likely get turned on in a month or so. Is sort of the rough target for that.
okay. So quick 2 questions. One, when a Bitcoin wallet is created, you said it's created every week. Is everyone's Bitcoin held in the same wallet during that week? So you might have 1,000 people that all move Bitcoin in that wallet. I see you shaking your head. Yes. That's a simple question. What about the question of why would any of these Bitcoin miners or these miners on the Threshold network, how many of them are coming back with different answers? Like, are you seeing anything less than 99% have, you design it to have 51, assuming there's like some mass attack or something, people get together and try to flip it. But have you seen anything less than 100 or what's the current?
Yeah. I mean, so far after it's run, I would say, but for about a month and a half, everything has been working correctly. Obviously, like, but it's the TBL right now is relatively low as we just verify that it's stable and everything is working correctly. But so far, knock on wood, so good. There's essentially like 2 ways for a node to become either malicious or just not function correctly. The first is like a node just becomes outright malicious and tries to collude with all of the other nodes to essentially steal the underlying Bitcoin. Mm-hmm. So that's obviously bad. So if they sign, if the wallet signs any transaction that's not a valid redemption transaction, they send it to, some unknown address. That's not good. That's a failure case. And there are some mechanisms that we can talk about that try to minimize that risk, including like slashing. So if something like that happened, all of the nodes on the wallet would get slashed, they would lose their stake. And so there's this economic disincentive to do that. And then there's also something called coverage pools, which is essentially like an insurance backstop that to the degree that they will make that wallet and those users that were deposited into that wallet whole. But then the other main way that a node could misbehave is not necessarily like outright maliciousness. It's just non-availability, right? So if a node just goes offline because there was a software failure or hardware failure or something, then obviously it's not going to be around to sign a transaction. So as long as 51 of 100 of the nodes are not malicious and online, then the system will behave exactly as it's intended. So you would need quite a lot of nodes to like simultaneously go offline for there essentially to be like a denial of service. So if you only had 40 of the nodes online and for some strange reason, 60 of them were down until 11 more came back online, the system would not be able to redeem back to Bitcoin from that wallet. And this is probably getting into more detail, but like there's some fancy essentially wallet rotation and sweeping things that happen to move like very old wallets. So obviously the system is only a month and a half old right now, but let's fast forward to like 3 years from now. If the system's holding a lot of Bitcoin and you have a wallet that's like 2 years old, it's possible that some of those stakers that were on a particular wallet might not be around any longer. So basically there's this heartbeat mechanism that just sort of checks the essentially health of a particular wallet. And if it falls below some threshold of nodes not responding, the Bitcoin in that wallet gets swept to essentially a fresher or newer wallet that is more healthy.
And why would a wallet not be healthy?
Well, let's say like you're a T staker and you're running a node and then you decide you don't want to be a T staker anymore, right? You start unbonding your stake and you're just like, I'm no longer interested in crypto, or I want to like sell T for ETH or USDC or whatever, but you're just going to leave the network. There's an unbonding period of 45 days. So you have to just wait this sort of cooldown period. But after that, you can withdraw your T stake and essentially stop running a node. So over a long enough period of time, like over the period of years, some of the earlier wallets might have more staker churn. And so we just have this mechanism to basically prevent essentially any of the wallets from becoming unavailable due to stake or churn.
Because the ceremony to create the wallet, the miners that are part of that initial creation of that Bitcoin wallet, they're the only ones that can give that quorum. It's not like new miners come online and then they have the right to authorize old ones. It's only the ones that were part of that key generation.
Exactly. Yeah.
That's interesting. What a good way to design it. What were you doing before this? Were you designing something similar, or how did you guys?
I mean, I've been in crypto for quite a long time. I got into crypto, I think it was 2014, if I remember correctly. I went to SF Bitcoin Devs user group, which is this like hacker space called Hacker Dojo in the Bay Area, and had been like vaguely aware of Bitcoin for like a year or two before that, but hadn't really dug into it. But then at that point, just ended up falling down the rabbit hole and getting super fascinated by first Bitcoin, but then at the same time, Vitalik was doing like the roadshow for the ETH ICO. And so that was also very fascinating. In that initial SF Bitcoin Devs user group that I went to, there was, I think, 6 people. One was, of course, I was there. Michael Agorov, who I ended up starting NuCypher, which is like the precursor project to Threshold, along with Keep. And he and I ended up starting NuCypher, and then he later started Curve Finance, the stablecoin exchange. One of the founders of Definity, one of the early contributors to Cosmos. So like a very small group of people that it turned out to be like, I was very fortunate to like get to interact with a lot of these early contributors to the ecosystem. But in retrospect, like a very special group of people that it was pretty awesome. Just I just happened to randomly go to this meetup. And I'm sure if like you went to the equivalent of the Bitcoin Devs user group now, it's probably, well, I don't know. We've been in a bear market, or quasi bear market for a while. So maybe it's a little bit smaller, but I'm sure it's significantly more than 6 people. But yeah, after that, Michael and I just started building a lot of stuff in crypto with sort of with a focus on privacy, but we were doing stuff on Counterparty and Mastercoin, which were these like layers on top of Bitcoin that tried to add some limited functionality to Bitcoin. And then when Ethereum launched, we started doing some experiments there, and ultimately ended up starting this project called NuCypher, which was a data privacy and access control network that used threshold cryptography, basically the type of very similar cryptography to what's used in Threshold. And we ended up building that over the course of a few years. And ultimately that merged with Keep into what's now Threshold.
And when you say Threshold is the name of the network, is there also a term for like Threshold?
Yeah. So essentially the reason why we call it Threshold network is because the primary technology that powers all these applications, like tBTC that we talked about, so that would be like the distributed key generation, threshold signatures. That's all like falls under the umbrella of something called threshold cryptography. And threshold cryptography is very simply, it's the idea that you take some cryptographic primitive, whether it's like a cryptographic signature or an encryption decryption operation or a key generation, and you split it up across many nodes. So instead of doing it on one machine, you split it up across 100 machines, and hence like the threshold. So you have 100 machines. Some threshold number of them have to essentially cooperate in order for the operation to be valid.
Interesting. And would you call Bitcoin itself a threshold system because you need multiple miners to like validate a transaction?
I guess in a sense, I don't know that I would describe Bitcoin. I would describe Bitcoin as like a distributed system, and there are some like a multi-sig, for example, is like kind of a threshold cryptography, threshold signatures. Like different parts of Bitcoin can be threshold cryptography. I'm not sure that I would describe Bitcoin as itself as a threshold cryptography sort of concept. Although like, I don't know, there is a sort of an argument there.
Yeah, I guess it's a bit nomenclature. What are other projects doing something similar? You guys launched just a couple of months ago. Is there other alternatives besides Threshold and the BitGo for wrapped Bitcoin that are really working?
So there are a few other alternatives to or alternative Bitcoin bridges. As far as I'm aware, all of them are essentially centralized in the model, more like the previously existing wBTC. So there's obviously wrapped Bitcoin from BitGo, which is for the king right now. I think there's like, I forget off the top of my head, but I think it's like 2% of all outstanding Bitcoin sits on the wBTC. And there's a few newer projects. Obviously Ren for a time was quite large, but now has sort of gone away post Alameda. I believe Avalanche has something called BTC.B, which is kind of similar to wrapped Bitcoin. There's like a consortium of folks custodying the data cut being the Bitcoin is not permissionless. It's not decentralized in the sense that anyone can join that consortium and operate a node. And I think there's a few others that are sort of essentially like Ren clone. I think like multi-BTC maybe, and I'm sure there's a few others that I'm not familiar with that maybe are much smaller.
And do you think that these approaches to allowing Bitcoin to be functional, say, we'll just take it for granted that people want to use it on Ethereum, since Ethereum is the most sophisticated smart contract layer. Do you think there will be like Bitcoin will just dominate the centralized model, and then on the decentralized model for wrapping Bitcoin, whether it's Threshold Network or somebody else, they'll just be the best place to get it. And then there's a kind of nonlinear returns that create, I don't like the word monopoly, but it's a simple way to explain like consolidation in a marketplace. When you have a marketplace, the largest marketplace tends to have the best prices. They attract more people. The marketplace grows, makes it harder to compete. And it's great. I mean, there's sometimes downsides to it, but sometimes it just is the best outcome.
Yep.
Do you view like there will just be BitGo will just win the centralized model? You guys are trying to win the decentralized approach, and that things will become more consolidated, even if you have a decentralized approach to it?
Yes. Well, I mean, I think there's an argument that it's very consolidated now, particularly with Ren sort of going away, where wrap Bitcoin's market share of big bridge Bitcoin is extremely high, not certainly probably 95+% at this point. I think the Ren experience showed very well why, at least I personally would not use any centralized bridge other than BitGo. Like if you're going to use a centralized bridge, just use BitGo. Like,
yeah,
don't risk of using some like unregulated, like non-transparent sort of like worse version of wBTC effect. At least like with BitGo, what you've gotten, they've successfully run this bridge for several years now. I would just, if I have to have a trusted relationship and use a trusted party bridge, I would prefer to trust BitGo than some unknown sort of multi-sig who I have no idea who's who's the signer on that multi-sig and where the Bitcoin's being custodied. So that's one. And then two, like I think where a decentralized version of that fits is, and I think actually like what's happened in this past week with the banking crisis in the US and SVB is actually a very good example of like why I think it's important that ultimately DeFi moves away from trusted party bridges entirely. So obviously the demand for decentralized permissionless bridge right now, there's a ton of demand that Ren was previously capturing that is from people who like, for whatever reason, can't mint and redeem using wrapped Bitcoin. So like the long tail of retail users can't do that directly. So instead they would previously use Ren. I think once tBTC turns on redemptions, they'll start to use tBTC. So that's like the existing market. But I think what happened with SVB near collapsing, but like then like deposits also nearly getting wiped out, we saw how that kind of pulled in USDC. So you can almost think of like USDC is essentially like the wrapped Bitcoin of dollars, of fiat. And when it was unclear what was going to happen to the underlying fiat, USDC had a pretty extreme depegging event.
Yeah, it's crazy.
And like, that's the risk of like using these centralized bridges is you're exposed to regulatory events. You're exposed to a lot of what we talked about earlier in the call, and these things can be censored, right? Like if the US government went to Circle tomorrow and said, or maybe the US government, like it's feasible that they could have just said, we're making every depositor whole at SVB except for Circle.
Right. They could have.
And so then the depeg is like permanent, and like maybe there's some sort of, I don't know what happens if it would just trade at like at a discount, or if it would sort of start to death spiral as people started to redeem. But like these custom party bridges are very exposed to that kind of thing. It wouldn't look exactly the same if it happened to a Bitcoin bridge, but like in principle, the ideas and the effect is very similar. So I think it's important that like long-term that and that was the reason why I was interested in the space to begin with, when I went back in 2014, when I went to SF Bitcoin Devs Group, is that we could create these like immutable, censorship resistant, permissionless systems that are essentially unstoppable, that like no one controls, no one can stop. They just work. And they're just like, that's the smart contracts on the Ethereum blockchain or some other chain. And it's transparent how they work. And you don't need permission from anyone to interact with them.
What do you think about that? I mean, when you saw USDC depeg earlier in the week, were you like, oh yeah, that's obvious? Or were you like, holy shit, this is a very big deal? I mean, what was your emotional reaction to that?
Well, I think on an emotional level, it was, and a psychological level, I think it was a little bit. I mean, I knew that I expected that it was going to happen going into the weekend, especially when Coinbase turned off redemptions, because obviously with no redemptions, like there's no way to hold the peg, but it was still like kind of to see it actually happen, because I think I and a lot of other people viewed USDC from like the three big, like centralized fiat custody stable coins as probably like the most reputable or legitimate or quote unquote safest of the three. And that turned out, at least temporarily, to not be the case.
Yeah.
And so fortunately for Circle and for USDC, and saving judgment on whether it's like a positive thing overall, but those deposits were backstopped and made whole. And obviously come Monday, they turned back redemptions on and it returned to but yeah, I think I don't know what's good. I don't know what like long-term implications that will have for USDC and Circle. I mean, clearly this was a shock to a lot of people, and I will see if Circle is able to regain that trust and recapture. I think there's been quite a significant amount of redemptions, but we'll see what happens. I think ironically, a lot of that market cap has flowed to Tether. But yeah, I think it's
okay. So, and it's ironic because Tether is less transparent, or have they publicly admitted that they hold less than 100% of the deposit on the balance?
I'm not sure off the top of my head if they're under collateralized now, but they have been under collateralized in the past, right? If you remember, like with the Bitfinex half, like it was explicitly backed by, I believe, like Bitfinex IOUs essentially for a while, partially backed. So yeah, I mean, credits to Tether. Like I think a lot of people expected something bad to happen to Tether.
Yeah,
a long time ago, and it hasn't. So that's to them for holding a peg for quite a long time, and obviously a very adversarial regulatory environment, particularly in the early days when Tether got started. Like I think the USDC and well, not anymore, BSD for a while had a clear regulatory framework to work in than Tether did. But yeah, I mean, like, yeah, I think it all just goes back to like these things. In my opinion, any trusted party bridge that is exposed, particularly to like a real world entity, is just going to be extremely brittle. And I think the vision for DeFi and for us at tBTC and other projects, like I think Liquidity is a good example of like a less censorable stable coin. I think what's interesting and compelling about blockchain is like, we don't have to rely on these sort of brittle intermediaries. And we've just seen over the last year, time and time again, like what happened when we do FTX, Meetup, SVB, I think it's hopefully like, I think like the optimistic side of me says like, these are great examples and we'll start to learn from them and improve and build more robust systems. That's my hope, at least.
Yeah. I feel I have a couple thoughts on this. I'm curious to get your feedback. I feel like there's a recognition now that free social networks have an implicit cost, and that you're the customer, and that because you're the customer and you're not paying up front, there's some non-obvious price you'll pay later, right? The social network, Tristan Harris, like there had been a lot of talk about that maybe 3 to 5 years ago. And I feel the same thing as in banking. When I sign up for a bank, it's SVB, and I pay them nothing. In fact, they pay me to hold my deposits in there. Where's the price for that service? And the price you pay is like a 1% risk, 0.5% risk that their investments are going to default. And it happens once every 1,000 banks or once every 50 years. It's a rare occurrence, but I think people, even now on Twitter, I see the rhetoric is like, these depositors thought with 100% certainty they were putting their money in. But if you knew that this bank was allowed to take the money out and put it somewhere, anywhere other than USD in which you deposited, then there obviously is a risk. And so where's the bank that just says, okay, I have $10 million. I want to put it in a bank. I want to pay that bank to be secure. It's $200 a month. You have to pay $200 a month for that service. It's like, then the bank can be profitable. Then you could be guaranteed that they're going to keep the money there, that you're not going to have the default risk. It seems like it's almost a fault of the implicit business model inherent in banking itself. And I know the Fed wants to keep that cycle going. They want to keep banks moving money. So it's almost by design. But that to me seems like the root of it, in which very little discussion gets brought up about.
Yeah, I mean, I think that a lot of interesting points you brought up there. Like, I guess fundamentally banking is about maturity transformation, like right, taking short-term deposits as liabilities and then lending those out longer term to earn a yield. And I think that historically has been very important for just economic development and activity in this country and others. But I think you're right that most people, and you're definitely right, because this is the expectation of the vast majority of depositors and like tech startups and small businesses that were depositing over the FDIC insured limit at SVB. Like I think they're like in principle aware that this is happening, but they don't fully grok like the implications of that. Like you just assume like you're depositing your cash in SVB, it's safe 100%, like no worries, you're going to be able to access it whenever you want. But yeah, that turned out to very nearly not be the case this past weekend. And it is interesting. Like I think there is a huge amount of demand for something like you described, where it's a quote unquote bank that's not lending it out. It's not in the business of the maturity information. It's just taking deposits and potentially charging a fee. I think like there's probably like some resistance, or maybe not after the recent events, resistance to like paying for a bank account or like earning like a negative interest rate essentially. But I think like there's clearly the demand for something like that. And I think partly the reason why that doesn't exist, I believe, if I'm not mistaken, that the Caitlin Long's company, I think it's like Custodia or something like that. They were essentially, that's what they wanted to do. But they got their bank charter application rejected. Because I think they were just going to literally just hold deposits. They charge like a negative interest rate or some subscription fee essentially. But the regulator said, no, you can't do that. It's too risky. Which kind of ironic given what happened with SVB and now like increasingly more banks over the last few days.
Yeah, that feels like it should be a new reconsidered idea. Too risky is crazy. I mean, probably there's some political stuff going on there.
The aspect was that it was like going to cater to crypto directly or something. But yeah, very, very ironic after what happened.
Yeah. And there feels like there's a game theory happening where even if you're at USDC, you can see it where they had 3%, I believe it was 3 out of roughly 100 billion, maybe, of USDC and Circle had it in SVB. So for that time duration between SVB declares bankruptcy and Sunday afternoon, the Fed says we're going to backstop all depositors. That time window, the USDC depegged. And it seems to me that it's worth, it's not that it's worth 3% less, but that it's worth nothing. And that it is a race to the bottom because there's no incentive to stay in USDC if there's another option that is fully backstopped, is fully deposited. And it's like you walk into, you have a choice of 2 restaurants, right? And there's 100 people outside each restaurant. One restaurant has enough food for 97 people and one restaurant has enough room for all 100. Why even take the chance that you're going to be the last one and not get any food? It's like, so that's how I view it is like, it would make sense if the Fed said, hey, sorry, that's capitalism for you. You guys figure it out. We're not backstopping that. It would have just, I mean, how would it not? And everyone would just rush to get out and who's buying at that point and price collapse. Like Luna was, I mean, sort of an example of that where they had, it's not like they lost everything, but they just had less than the depositors had.
Yeah, I think you're right that I'm not sure what would have happened.
It would have been
that if USDC had lost their 3% or whatever it was, then USDC would just trade at whatever the discount was. But I don't know that, I'm not sure I think something different could have happened where like everyone is in this sort of prisoner's dilemma where like, wait, I need to redeem first because if I redeem now, I will get $1 of $1. Right. And I'm just going to try to stick everyone, like the people that redeem after me with the full loss. So there could have been some, and yeah, I think like it's different than Luna because there was like actual like non-endogenous collateral where Luna was like essentially programmed.
Right. Okay. Maybe not a good example. Yeah. Yeah.
But like, I think you could have seen like something maybe not quite as extreme, but like a very similar impact where like everyone's rushing for the exits to redeem. And then like whoever's left is stuck with the full $3.3 billion loss or whatever it was. Or like, theoretically more if like if there had been contagion and the other banks where some of that cash was deposited had also gone down.
Yeah. Yeah. It feels like some of these things, while in my lifetime, I have not seen bank runs and collapses, there were something like 100 or 270, somewhere in that ballpark of bank failures in the year 1930, I believe it was 1933 alone. So once it does snowball, then what we're talking about becomes just like dominoes. It just is why and people are saying this, but why put your money anywhere other than the most secure place possible? And so massive consolidation happens across the board. And I mean, that does not seem like a good thing for the banking system. It gives more control and influence to the federal government to have oversight into those centralized banks. And it effectively takes the guardrails off of inflation. And I mean, are we in that situation? Like, there's always a price you pay. You could let all the depositors at SVB go bankrupt. That would have sucked for sure. But you're paying the price then. If you backstop everyone and you print trillions of dollars to do that, well, you're paying the price tomorrow in that now there's way more money in circulation. Everyone's money is worth less. And so everyone that holds USDC is the ones who all pay the price. Is that how you see it? I mean, are we seeing right like middle of this?
Certainly once the bank run started at SVB, like there's no good options, right? Like, as you said, like ultimately they ended up backstopping deposits and preventing a lot of startups and small businesses from getting like wiped out over. And like, I think there's been some chatter on like Twitter and other places saying like, hey, like as a business, do you need to essentially like diligence very closely, like where you're depositing your money, which I mean, in retrospect was maybe good advice with SVB in particular, but fundamentally, like that's not, if you're a startup or a small business, like there's not a good use of your time to have to like, with such huge friction and overhead that's like distracting from whatever your actual business is, of like diligencing like where you're just depositing your capital. So that's going to, like, if that was like how we went forward and said, okay, these depositors got wiped out, that's capitalism. Going forward, everyone just diligence your bank. Like that's just a huge amount of economic friction that you're introducing to like, everyone. And I think you're right that like everyone just said, I'm not going to do that. I'm just going to withdraw everything and put it in Chase, Wells Fargo, Bank of America, wherever I know, like with full certainty, like the government is going to definitely backstop that. That was like sort of the one option. And then the other option is what ended up happening where they did backstop deposits. And I think effectively the way that happened was they basically, obviously explicitly backstop deposits at SVB and Signature. But they also, I think, are allowing most of the other banks are in a very similar situation where they're underwater on like their long-term government bonds and mortgages. And now the government's saying that you can borrow against the nominal full value of those long-term securities. We'll lend against that as if it was, trading at par, even though it's fully underwater. So that there's this like sort of like stealth quantitative easing that just happened effectively with that. And yeah, I guess the risk there is like, this could obviously work against the Fed's goals of trying to bring down inflation and sort of cancel out the efforts that they've been doing there so far.
Do you see an inevitable conflict that the Fed will recognize crypto, Bitcoin, maybe in particular, as like the target? Because everyone, when they recognize that there is an insane amount of money being printed, and they have options. They don't have to hold it in USD. They could hold it in Bitcoin and they could own it. And so they're primarily concerned about two things: the security of the deposits, which naturally they have some concern over, and then the inflation, the value of the actual the underlying currency. If people start really moving to Bitcoin, I mean, the government even stopped in the resale or the bankruptcy proceedings with Signature. They said in Silvergate, whoever acquires this business can't operate the crypto aspect of it, which was like, that's their main value proposition. That's like what I think of these businesses as being specifically catered towards crypto companies. Does that have the obvious implication would be, okay, the government is recognizing and they're starting to block the exits from USD into BTC. But maybe are there other externalities here? Like, are there large crypto companies that use banks, like, and they would start to fall? I mean, I think of USDC as a crypto company, cryptocurrency, but it's really not. It's just like you say, it's wrapped.
Mhm.
What are your thoughts? Do you think there are unforeseen negative externalities if these banks are just not allowed to touch crypto at all? The obvious would be it's really hard for me to move money from USD into BTC, but I think like what else comes of that?
Yeah. I mean, it's certainly interesting that like effectively over the course of a couple of weeks, like the two like explicitly crypto friendly banks, Signature and Silvergate, a few weeks before, are now gone. I don't know that SVB was known for being as like sort of crypto friendly as those two, but they did definitely bank a decent number of crypto companies. And so those options are now gone. It's historically not been easy for crypto projects and crypto companies to get banking.
Yeah.
Probably not going to be any easier going forward. But the other interesting thing that I think has happened the last few days, like maybe for one of the first times in its existence, we've actually seen, well, that's maybe not true, but like, I think a very start of what happened to Bitcoin and to a lesser degree, some of the other crypto coins the last few weeks is in response to this essentially monetary debasement that happened when the Fed backs up all these deposits and said banks can borrow against the nominal value of their long-term assets. We saw like Bitcoin very explicitly like rise in price and in value as a response to that, which is like kind of fundamentally what Bitcoin is, right? It's like a hedge against monetary debasement. Like the last few years, it's traded much more in line with like tech stocks and other risk assets. So I think that was an interesting side effect of what happened in the last few days.
Yeah. I don't think up until
interesting if that continues.
I think you're right that historically it has been looked at as just another asset class and not a alternative to escape inflation. But it feels different now. It feels like with bank failures and really significant bank failures and the threat of more bank failures and the massive amount of printing happening, that people, I think before they're like, oh, bread's going to be $6 instead of $4. Oh, gas is more expensive. I could bitch and moan, but I'm not doing too much differently. There's a certain like amount of kinetic energy or static energy, static friction you have to overcome. And it feels like this is the kind of thing that could do that. For better or for worse, I don't want to say it's good or bad, but it is what it is. Yeah.
Yeah. I mean, I try to be like a technologist essentially and very like optimistic about the future, I think by nature. So like my hope is that like all these bad things that have happened the last year, we learn the correct things from them. So like we learn that we should build robust, decentralized, permissionless, or censorship resistant primitives and not rely on the sort of like things that brand themselves as DeFi when they actually aren't. Hopefully that's like the learning and the takeaway that we as like a community take from all of these events.
It has to be. I mean, it's not going to be unanimous. Some people won't pay attention or they'll forget or they'll be biased by greed or something else. But the vast majority of people witness what's going on. Either they lost directly or they know someone or they just are watching them sidelines. So those lessons are absolutely penetrating the psyches of people. So that's always the plus side. It's like FTX collapse. Oh, that's sad. That's a tragedy. It is, but we all have to learn from it. It's like, do you want to get sick? No, but when you get sick, your immune system gets stronger. So I'm like, there's always some price you have to pay to be alive and to do things. So I view it's better to get like scratched and bruised and occasionally break something than to like get something that just takes you out completely. That's my philosophy. Right before we wrap up, I want to make sure. So with Threshold, you guys have this T coin, right? Threshold coin. Is that the method for structuring the monetary growth of the projects? I mean, do you look at this as like, okay, I want to build this so our developers who own T coin become wealthy for all their hard work by the increased value of the coin? Is that like the structure of finances you look at for the project?
I mean, I think the primary goal is for this. Like, I think it's very important that a decentralized Bitcoin bridge exists. Like, I think we would have failed if just 5 years from now, everyone's still using wrapped Bitcoin or some equivalent trusted party bridge. And I think the role of a T token is to make that sustainable. So obviously, like, you need some sort of economic alignment so that you ensure that these nodes are behaving correctly and they're not just running off with Bitcoin. And that's where the T token comes in. So the way that the bridge works, there's essentially a bridge fee. So every time someone crosses, they emit tBTC or they're eating back for native Bitcoin, the network takes a small percentage of that. So right now it's 0.2%. This is ultimately like a governable parameter. So the DAO could vote to adjust that rate up or down. But it is important that like, you know, I think this is like one of the core tenets of crypto is like, we want to align incentives. We don't want people to just do something out of like altruism, because like ultimately like somewhere along the line, like that's going to fail. So you need the incentives to be aligned correctly. Like this was like the sort of core innovation of Bitcoin with proof of work is like how you do that to solve the double spend problem. And that's, you know, in a somewhat of a similar sense, like aligning those incentives. So everyone who is an independent economic actor that's involved in the network is incentivized to do the correct thing according to the protocol rules. That's where like you can do some interesting things with, you know, with ERC20 tokens and other tokens.
Got it. So when you think of like designing this, it's not, somebody shouldn't look at the T token and be like, I want to buy this because I think it's a good project and it's something that would grow in value. It's not that. It's more, you make money by being a miner.
The function of T token is primarily to operate a node and essentially allow you to do work for the network. And you know, just get compensated for that work through fees. And then the second is governance over the DAO and the system itself. So there are a set of governable parameters like the bridge fee and a few other things where token holders are able to essentially use their tokens to vote on any parameter changes or modifications to the system.
Okay. So it would be more like miners make T tokens and then they would trade it right away for Bitcoin and use that as use some other method of stored value. This is just like
or they add it to their stake, you know, and they just have, they're selected more often essentially for, you know, for a wallet.
Gotcha. Yeah. There's some benefits to it. Interesting. I wanted to touch on that and I know we didn't get to it earlier. I love our conversation, MacLane. We tackled, I think we obviously spent a lot of time talking about Threshold, but I feel like it was really useful to describe what you guys are doing, and not for the purpose of just promoting your project, but for the purpose of understanding now that there's a lot of economic pressure to move into Bitcoin. What do you do when you're in there? Can you put your money to use? And kind of mapping out these two centralized and then decentralized with Threshold projects. It was really useful, really interesting, and I hope people dive into it. And I wish you guys nothing but success. So hope to have you back on today.
Yeah, it was a great conversation.
All right. Cheers.